Welcome to In Conversation. I'm Marco Fantozzi, investment analyst in the research team at Pitcher Partners Investment Services. ETFs have been around since 1990, when the first one was used to track the top 35 companies at the Toronto Stock Exchange. Since then, ETFs have grown to over $8 trillion in market cap, with $124 billion in Australia alone. Thematic ETFs are the newest iteration in the ETF landscape. Let's find out more about them today. Welcome. Thank you for joining me. So firstly, what is an ETF?
So an ETF is a pooled investment vehicle. You can think of it just like an unlisted managed fund, but unlike an unlisted managed fund where you have a paper application or you apply through a platform and it takes 2 or 3 days before you get your investment, with an ETF you can get real-time access through buying it live on the ASX.
It effectively takes the characteristics of a stock, being the exchange traded component, and also a fund being a diversified basket of securities. So whether it's shares or bonds or commodities, an exchange traded fund is just an easy way to trade a basket of securities.
And so how is a thematic ETF different?
Traditionally, when people think about ETFs, they think about broad market passive exposures. So for example, the S&P 500, the ASX 200, the FTSE 100. Now, those traditional ETFs are gaining exposure to a portfolio of companies defined based on either a geography or perhaps a sector like healthcare or energy. Thematic ETFs are very much different in that they are unconstrained when it comes to companies. They don't need to worry about which industry or sector code, which country particular companies come from. What's key to a thematic ETF is that all of those companies are all connected to that same underlying theme. If we think about, for example, our Betashares solar ETF, that's got companies from China, Europe, US, across industries from IT, finance, utilities. What ties them together is their connection to the solar industry.
A thematic ETF is just more narrowly focused. So it's quite a targeted exposure. It will be an emerging trend, so something that's structural in terms of its impact on markets, something that's going to change the economy, change business, change society. One very topical theme is clean energy. And so there's a mass adoption of clean energy. We actually have a clean energy ETF, which trades under the code CLNE, and it just provides exposure to the 30 largest and most liquid clean energy stocks globally.
Can you tell us how the market making process works?
With ETFs, liquidity is provided by market makers. And so I'll probably take a step back and talk about there's a primary market and a secondary market. Secondary market being, say, the ASX, where you buy and sell units on shares and ETFs and the like. So we issue units to an institutional investor called an authorised participant in exchange for the securities in the actual underlying fund. That authorised participant acts as a market maker, and they effectively interact with buyers and sellers in the market so that people can purchase securities, purchase an ETF and get access to ample liquidity in there. They can do that because they know the underlying holdings and therefore can accurately price the actual ETF.
What are the biggest misconceptions of ETFs?
Probably the biggest misconception is around liquidity. That, for example, when you see the amount of volume traded on market or the bid and the ask, that doesn't necessarily represent the liquidity of the ETF itself. People confuse stocks for ETFs in that regard. The liquidity of an ETF, broadly, the best way to describe that is it's as liquid as the underlying basket of stocks which make up that ETF.
We tend to think that the starting point of building a portfolio shouldn't be just the standard index. So, for example, in the Australian market, we have an equal weighted index, and it's based on the view that regular index is just way too concentrated, given that the top 10 holdings are the big four banks plus Macquarie, a couple of big resource stocks, and effectively half of the standard market index. And so equal weighting just gives more sensible diversification.
Can you tell us some of the pros and considerations when investing in ETFs?
Advantages of thematic ETFs is they typically offer very strong growth profile that you may not have access to elsewhere in your portfolio. They also, allow you the ability to generate alpha or outperformance. I mean, that's fundamentally what you're trying to do by investing in a thematic way. And that's enabled investors to replace, for example, high-cost active managers. So that's certainly been, a real theme that we've seen, people looking to use thematic ETFs in that way. And the final point really is, if we think about how you should approach thematic investing, we believe you're looking to invest in long-term structural growth. So your investment time frame should be extended. You're also, we find that people are very, engaged in themes that they invest in. And this helps with, whether it's your personal engagement with your portfolio or your client's engagement with their portfolio. It changes the way you look at your portfolio and increases your time horizon, which we think is only a good thing. I mean, a key consideration, however, with themes and with thematic ETFs is that because they're tied to that theme, they have that theme-specific risk. It's really important to recognize that can come with higher levels of volatility than a broad market ETF. So when you're incorporating thematic ETFs in your portfolio, sizing them appropriately and figuring out how they can add diversification to what you already hold is key.
Can you tell us how you determine what the next theme an ETF will be developed into?
Yeah, that's a really good question. At Betashares, there's 3 key attributes we look for. And the first of those is that when we're seeing an evolving theme, we've got to ensure that there is an investable universe of stocks available. It's no good, ETFs are designed to be liquid, tradable. It's no good trying to pursue investment in a theme where there simply isn't a broad enough pool to provide diversified exposure to that theme. The second consideration is this a fad? Do we think there are long-term drivers where this theme is going to play out over multiple years, ideally decades, so provide that long-term growth potential? And we saw obviously a lot of fads through, for example, the disconnections in COVID. It's about looking through those short-term trends to longer-term underlying trends. The third critical aspect is the ability of companies who are tied to that theme to monetize the opportunity. They may be very strongly growing companies today, but is there a path to profit? Do they have competitive advantage? Do they have some sort of monopolistic power in the way that they're pursuing that theme? All elements are important, and we think that they're very critical to how you should look at investing thematically.
Once a theme has been decided, how do you bring that product to market?
When you're looking at a new theme, you need to educate yourself. We spend a lot of time researching a theme, talking to analysts in that area, talking to industry experts. We work with index providers around the world who may have expertise in that area. We've got to work with them to find the right way of building that thematic exposure. It might be that the most appropriate way of selecting a set of companies tied to a theme is through looking at very detailed revenue breakdown as to see, I mentioned before, solar, the proportion of revenue generated from exposure to the solar industry. That might be a way that you select companies tied to that theme. However, you may also look to other ways of selecting companies. For example, use an expert panel or investment committee that identify the stocks tied to a theme. All of this goes into the process of selecting the right index, a true to label index. And at the end of the day, if we're not happy with that process and the final outcome, we'll in fact, retire that or decide not to pursue that particular opportunity because this is a bit of an iterative process.
For us, with any particular theme, it has to first and foremost be investable. So if there's not enough securities available or not ample liquidity in those securities, we would absolutely never do it. So that's one part, is making sure there's an adequate range of underlying securities to represent that theme. The second part, and it might sound a little bit cliche, but we talk a lot about being pure play. So with that in mind, take the video gaming and esports example. We make sure that those companies, their bread and butter, so more than half of their revenue comes from video gaming and esports. So Microsoft has a Xbox, Sony has the PlayStation, they're big companies, that's an incremental part of their revenue, so we won't actually include those in the portfolio. It has to all be about being pure play for that particular theme.
So what are some of the themes that you are looking at the moment?
One of the most evergreen themes that we've seen is global cybersecurity. We have a Betashares global cybersecurity ETF hack. This has been, as I mentioned, themes are very specific to a particular industry or trend. And we've seen that like cybersecurity has become a non-negotiable, and over various periods of the market cycle, and including periods of volatility, we've seen that these stocks have done incredibly well over the journey. More broadly, the energy transition that we're embarking on is clearly critical. It's a multi-decade trend, and trillions of dollars will be spent investing in new technologies, in different ways that we need to organise society in order to move that transition to net zero. And so themes connected to both the energy transition, energy efficiency, solutions provided by companies that really allow their clients to drive their emissions down to zero, we think is really a strong place to play, and it's where our economy will evolve towards.
We are really focused on looking at particular themes that make a lot of sense. I will say we've had 9 years in the Aussie market, we've got 30 ETFs, and we've only got 2 thematic ETFs. So we certainly don't bring out things that are marketing fads, essentially. A big focus for us has been on the growth opportunities around the move to decarbonisation. So we have the clean energy ETF, and I dare say that we'll be continuing to look at themes associated with decarbonisation more broadly.
How has the use of ETFs evolved over time?
Look, I think one of the really good things about the ETF industry is the amount of effort that as an industry we put into educating investors as to what's available and how ETFs can be used. Initially, ETFs were pretty typically used as passive broad market exposure. And the thinking was that if I can just about match the market, I'm going to do okay. Now the choice of ETFs is far wider. There are actively managed ETFs, there are sector ETFs, there are thematic ETFs. I can look at the way I structure my fixed income in different manners. So with that choice comes the ability to pull a lot more levers. And with the increasing focus on cost that a lot of investors are really looking at, ETFs are really an excellent vehicle for giving someone the power to build their own portfolio, do it in a cost-effective manner, and really understand the drivers of performance due to the transparency that ETFs offer into your underlying holdings and exposures.
One of the big changes has been, and this is just more from the chair I sit in, so I've been with VanEck for 8 years, and investors, so stockbrokers, institutional clients that 7-8 years ago would have told me effectively to go away if I was to talk about an Aussie Banks product or an Aussie Resources or gold miners, because they would buy those stocks directly. All of a sudden, they've become adopters of ETFs. They've gone, it's an efficient vehicle, a liquid vehicle to just express a view on particular subsectors or particular thematics as well. So that's been a big change.
What are some of the measures put in place to reduce the amount of price impact ETFs have on the market?
When you're looking to build an index, create an index which an ETF is going to track, thinking about liquidity, not just in good times, but also in times of crisis, is key. When we look at the rules used to define an index, they'll often use particular screens, whether that be liquidity screens or market cap screens. Most ETFs are market cap weighted, and that's often a good way or a good proxy, if you like, for the liquidity of different companies. So firstly, by having a diversified pool of stocks and weighting them relative to their size or the liquidity is the first step to ensuring that you're not impacting market. But key to this overarching thing is spending enough time in that index construction process to ensure that the product you have will work not just in good times, but in times of crisis.
Well, I'm going to give the politician's answer if I disagree with the premise of the question, largely, not entirely, and I'll come to that in a moment, but largely in highly liquid asset classes So large cap equities, where the trading volumes on the underlying securities are just phenomenally large. ETFs aren't big enough and don't trade enough to move the dial. So that would be my view there. However, there are some exceptions to that rule. And when we look to design products, we will only do it in asset classes that are highly liquid. So one example where we just wouldn't touch would be a thinly traded market such as Australian hybrids, where the trading volume is just so thin that you couldn't possibly responsibly run billions and billions of dollars worth of exchange traded products over that market.
Thank you for watching. To quickly recap, we heard from ETF providers on what ETFs are, how they work, how they come up with new themes, and some of the pros and considerations when investing in ETFs. If you'd like to hear more information, feel free to check out our website or talk to one of our advisors.